In the mid-90s, Asia was booming. Then, a single currency, the Thai baht, became the target of a legendary investor, triggering a crisis that shook half the world. Welcome to this explainer. Today we're unpacking exactly how the high-stakes, cutthroat world of currency speculation brought down what looked like a totally invincible economic fortress. We're talking about the 1997 Asian financial crisis. Let's dive right in, because understanding how this massive domino effect played out, well, it's absolutely crucial if you want to understand how today's global markets actually work. First up, Section 1, the Asian economic miracle. To really grasp the crash, we have to understand the sheer height of the boom that came right before it in the late 80s and early 90s. So what were the building blocks of this so-called Asian economic miracle? Countries like Thailand, Malaysia, Indonesia, and South Korea were pulling in massive annual GDP growth. We're talking 8 to 12% year over year. But how? Well, they had fixed currency exchange rates tied directly to the US dollar, which gave everyone a huge sense of stability. Couple that with high domestic interest rates, and suddenly these nations became absolute magnets for foreign capital. Investors were getting killer returns with supposedly zero currency risk. The catch? A massive chunk of this explosive growth was just being funneled right into non-productive sectors, like real estate. And that brings us to a really crucial concept: hot money. Basically, this is short-term, highly liquid capital that just zooms between markets, constantly hunting for the absolute highest, quickest return. This money wasn't building factories or long-term infrastructure. Nope, it flooded straight into speculative assets. Imagine a crazy real estate bubble in your own city, but scaled up to a massive national level. Just to give you an idea, in Bangkok, this created a staggering 200% excess supply in housing. It was a giant, unsustainable bubble built entirely on the illusion that the good times would never end. But, of course, they did end. Which brings us to Section 2, Anatomy of an Attack. Let's look at exactly how that fragile foundation cracked. Remember that stability I just mentioned? It all came from a currency peg. Thailand essentially fixed the baht at exactly 25 to the US dollar. For a while, this worked like a charm. But in the mid-90s, external shocks started hitting. The US dollar started gaining serious strength, and because the baht was tied to it, the baht strengthened too. Suddenly, Thai exports were way too expensive and totally uncompetitive on the global stage. Even worse, there was this fatal mismatch brewing behind the scenes. Thai institutions were borrowing US dollars on short-term loans and then turning around and lending them out long-term for local real estate, a recipe for disaster. Enter George Soros and his quantum fund. This right here is a textbook example of a speculative attack. Soros used a principle he called reflexivity. Basically, his team spotted a fundamental macroeconomic imbalance. The baht was wildly overvalued, and the peg was actively choking the Thai economy. So what did he do? He built a massive $10 billion short position against the baht. By publicly declaring the currency was doomed, he whipped up immense market momentum. He was essentially betting that the Bank of Thailand would eventually just run out of the US dollars they needed to defend that 25-to-1 peg. Naturally, the Bank of Thailand fought back. They bought up surplus baht using their foreign reserves. But look at this number. $2.85 billion. That is literally all they had left. To put that into perspective, before the attack, Thailand had a massive war chest of $38.7 billion in reserves. They burned through almost the entire thing in a desperate, totally unsuccessful attempt to defend their currency. Finally, on July 2nd, 1997, the inevitable happened. The Bank of Thailand simply ran out of dollars. They had no choice but to unpeg or float the baht. Its value collapsed instantly, dropping by more than half to over 50 baht to the dollar by early the next year. The crisis was officially on. But here's the thing. This wasn't just a Thai problem anymore. Moving on to Section 3, the domino effect. The collapse of the baht was a brutal wake-up call for international investors across the entire region. Panic spread like wildfire, and foreign investors rushed for the exits, yanking out credit and capital en masse. The immediate economic destruction was just mind-blowing. We're looking at a staggering 43.2% drop in nominal GDP per capita in Indonesia. Thailand lost over a fifth of its GDP per capita, and Malaysia took a massive 19% hit too. We're talking about decades of hard-won economic progress just wiped out in a matter of months. The contagion literally crossed borders overnight. In Indonesia, the rupiah plunged from 2,600 to $1 all the way to over 14,000. Just imagine you're a local business that took out loans in US dollars. Suddenly, your debt is more than 5 times larger in your own currency. Total bankruptcy was unavoidable.
In South Korea, massive conglomerates like Kia Motors went under. The Philippine peso plummeted. In Malaysia, Prime Minister Mahathir Mohamad even imposed strict capital controls and pegged the ringgit just to stop the bleeding, pointing the finger squarely at currency speculators for ruining their economy. With hundreds of billions of dollars evaporating and very real fears of a full-blown global economic meltdown, outside help was urgently needed. Let's look at Section 4. The IMF intervenes. The International Monetary Fund swooped in with multi-billion-dollar bailout packages for Thailand, South Korea, and Indonesia. But I have to note, this intervention was, and honestly still is, super controversial. The IMF demanded a structural adjustment approach. This meant aggressively high interest rates, slashing government spending, and basically letting failing banks fail. Critics, on the other hand, pointed to traditional Keynesian theory. They argued that during a recession, you're supposed to lower interest rates and increase government spending to stimulate the economy. So a lot of people felt the IMF's bitter medicine actually made the recession way worse for these countries.
But let's look at the IMF's rationale neutrally for a second. Stanley Fischer, the IMF's first deputy managing director back then, summed it up perfectly. For them, job number one was stopping the absolute hemorrhage of the currency's value. The only way to make the local currency attractive to hold again and stop people from panic selling it for US dollars was to temporarily hike up those interest rates, even if that pain meant bankrupting weak domestic corporations. In their eyes, stabilizing the exchange rate was the non-negotiable first step to survival. The pain was absolutely severe. But by 1999, these economies managed a pretty remarkable V-shaped recovery. Let's wrap things up with Section 5, Lessons Learned, and see how this whole ordeal changed global finance forever. Asian economies made absolutely sure they'd never be caught off guard like this again. They ditched those strict currency pegs in favor of floating exchange rates. They also started hoarding massive foreign exchange reserves, basically building up these giant financial shields so speculators could never corner them again. On top of that, they set up sovereign wealth funds, tightened up financial regulations, and created regional cooperation networks. This huge shift in strategy is a big reason why Asian countries actually weathered the 2008 global financial crisis much better than they did in 1997. They'd already learned the hard way. So, we've seen how vulnerabilities in a booming system met the ruthless efficiency of high-stakes capital. But I want to leave you with a provocative thought about the catalyst of it all. Was George Soros a market manipulator or just a brilliant investor? Share your strong opinions in the comments section. Thanks for joining me for this explainer, and keep questioning how our global economy really works.